My next guest is Peter Burris. He's the founder and CEO of Silver Crown Royalties Corp. Trades on the NEO exchange under the symbol SCRI. Peter, welcome.
Hi, James. Great to be here. Thanks for having me.
You bet. Peter, let's start off with an overview. Tell me what differentiates a royalty company from a normal publicly traded company in the mining space.
So the key difference here is that unlike a mining company, we do not incur any of the operating costs. So a royalty or a stream are essentially a revenue piece from the top line, and the only costs that we incur, although we get paid on the same metal, is by our own internal costs. So listing costs, director's office, insurance, etc. Whereas with an operating company, while they have labor costs, they have their energy costs, oil, gas generation on site, etc., all kinds of costs. So the margins for an operating company, generally 10-15% in a good market, in a great market, maybe 25%. And for the rest of the time, well, break even at best. I mean, there's an old saying that says 3 years famine, 1 year feast. And that's more like 6 years famine, now 1 year feast for the operators, the producers. Whereas with the royalty companies, because our margins are 95-99%, once we're in free cash flow generation stage, well, that's these costs, they don't have that impact on us.
Right. So again, with a royalty company, you're basically trading cash for a right to the revenue stream produced by mining activities. So you're not giving them cash for exploration and crossing your fingers.
That's correct. And in fact, that's how we set up the company as well. We can participate in the exploration upside of a project, but we don't necessarily take that exposure and that risk. So we're focusing on operating projects right now because we want to get to the free cash flow as quickly as possible. And then further down the line, we may look at exploration and that sort of optionality. But as of right this moment, it's all about the cash flow for us.
Sure. Okay, so then does the investor in Silver Crown Royalties experience any cash flow from the royalty stream?
That's the objective, yes. So we take a small stake from the operating mine and we get the revenue from that stake. So let's say a mine's revenue is 100 million, we get a 2% stake, 2% of that would come to us. Now, what we do is we focus on the silver component. So in the economic equivalent I just described, it's the same thing. It's a gold mine that's 98% gold by revenue, 2% silver by revenue. We would take that silver, and that's what gets paid to us as long as that mine is operating. We also have some minimum delivery provisions layered in as well to protect our investors. I can talk about that, but bottom line is we get a small piece of the revenues as long as the mine operates.
Sure. And how many ounces of silver are you streaming currently?
So right now our portfolio has 5,500 ounces per quarter. That's about 22,000 ounces a year. We're working on additional transactions as we speak. Hopefully that gets us to 30,000 ounces run rate in Q4 of this year. And that number is important for us because that's a free cash flow break-even number. So at 30,000 ounces silver, we become 100% self-sufficient, and we no longer have to go raise money in the market. We can, but we don't have to, and all the costs internally are covered by those revenues.
And how much did it cost the company to get to 20,000 ounces a year?
So to get to 22,000 ounces, we spent $6 million Canadian.
Okay.
So out of all the money that we raised, which was just over 10 million, $6 million went into the ground. We still have 1.7, 1.8 million on the balance sheet, and the rest was spent over 2 years on various costs associated with getting the company public, legal costs, due diligence costs, etc.
How much dollars does 22,000 ounces of silver equate to in your case?
In terms of annual revenues, it's about $1 million Canadian, 1.2 million Canadian.
So you get paid back in 6 years for your investment just on what you've got now?
Correct, yes. Now, that was because that included our first transaction, which arguably was not the most attractive in terms of returns for us. It was more of a proof of concept. But as we keep going forward, those returns do get higher. So to elaborate, to explain, first deal was 15% internal rate of return. Second deal was 20. Third deal was 25. And the fourth deal that we're working on right now is over 50.
Mm-hmm. Okay. And so where do you see being at the end of 2025?
At the end of 2025, if everything stays the same and we simply close on the transactions that we have in front of us right now, we should be able to do 80,000 ounces a year run rate this time next year, which would put us into a free cash flow position of over $2 million Canadian at these metal prices, which would allow us to pay a dividend. Now, $2 million in free cash flow, 2.3 million shares outstanding. I mean, could it be a 50-cent dividend? Hypothetically speaking, that would be the ideal objective for us as things stand today.
Sure. So that's incredible. You're streaming 22,000 ounces per year. You've got 2.3 million shares outstanding. Warrants?
We have two classes of warrants. There's an $8 strike warrant and a $16 strike warrant. And these are both listed. It's warrant A, warrant B, and they're listed. They're trading on CBOE, the NEO exchange as well.
Okay, very interesting. So give me some examples of some comparable companies that started off where you are today and have really had success with the whole royalty model.
That's a very interesting question, because I would have to go back in time to compare us, essentially starting from scratch. So Franco-Nevada, the second iteration, I mean, they were floated from Newmont. I think that the sort of best comparable would be something like Silver Wheaton, which is now Wheaton Precious Metals. Silver Wheaton started with nothing, and they created streaming in that they sold essentially from an arm's length party to themselves silver production from a project in Mexico. In this way, they created a debt type structure, which was never seen before in the royalty space. They called it streaming, and that's what it's called today. So because they started with literally nothing, just a concept, and created it from ground zero, that's exactly where we started from. If we go down the line, a lot of other companies were either seeded with royalties, or they were a collection of royalties that already existed. And we can go through all the origin stories for all the various other companies, but a vast majority of them started with royalties that already existed. They didn't create them. They were already out there. They either purchased them or they were packaged together for them, and they were essentially used as a vehicle to go public with. That's not what we do. We originate every single royalty that we have. And the reason for that is because there are no pure silver royalties out there. Don't worry, it took us some time to figure that out too. We didn't know this originally when we set out to be in the silver space, believe it or not. But we found out relatively quickly that every royalty that says to be silver has other metals, be it lead or zinc or gold or what have you. So if we just wanted the silver portion, we had to create the royalties ourselves.
So what incentivizes a company to allow you to have a royalty? Is it just the cash that's attractive, or is there some other benefit to them?
I would argue there's a significant benefit in ownership of Silver Crown royalties. Very much like what Silver Wheaton did 21 years ago. They gave up a portion of their own company to Wheaton River Minerals for their silver. And it was that part, ownership, that created the most amount of wealth for Wheaton River Minerals shareholders. So the operator benefited from Silver Wheaton's growth and their ability to layer in additional streams. As they kept growing, the stock kept going up, and ultimately 1/3 of it was sold by Goldcorp, who ended up through various iterations in the possession of Silver Wheaton stock from the Wheaton River Minerals transaction, and they sold that 30% for $1 billion. Now, am I saying that we're going to repeat that? Well, I hope so, but there's no guarantees. But that's exactly the approach. So what our pitch to potential sellers of silver royalties is, okay, you're a gold mine. 2% of that project is silver. The market is paying you 1.5 times sales. We'll offer you 3 times sales, but in our hands, in terms of revaluation, that could be worth 20 times sales, because that's where comparable royalty companies trade today. We think that we can get that multiple as well. In fact, we're very close to it today based on what our revenues are, what our market cap is. So as long as we continue to repeat and add these high return silver only royalties to our portfolio, I believe that revaluation argument can be made, especially from where we are today. So for a portional ownership of Silver Crown royalties, the vendor can get significantly more upside than if they were just to get cash, because that cash, well, they can just wait 3 years and get it anyway.
So where are the pitfalls in this? What are the risks to the royalty itself over the life of the royalty? What can go wrong?
The biggest issue will be counterparty risk. What that means is, are you doing a deal with the right people, with the right company, with the right management? Because at the end of the day, if they don't want to pay you, okay, so you have legal recourse, sure, but then you end up in court, and that's not a business model for us. As great as our lawyers are, we would much rather have them engaged in creating new royalties and new agreements and growing the company that way. So that is a risk, but that's a risk for everybody. I mean, that's a risk for Home Depot. So, it's just one of those business risks. The other one is in terms of overpaying, but because what we've employed is minimum delivery mechanisms, meaning if the project does not produce as many ounces as we thought that it would, they have to make up the difference from revenues from other sources. And because it's only a 2%, 1% impact to the economics of the project, well, if they can't make that up, that's a daily fluctuation in the metal price. There are other problems at the mine. So the other part as well would be things that are outside of our control. So for instance, government permits or government decides to shut the mine down, or there's an earthquake or something like that. The way that we protect our investors from those sorts of things is through diversifying as much as possible. So ultimately, we will not be deploying more than 10% of invested capital into any given project. What that means is that if 2 of those projects fail, 80% of them still work. So it's not the end of the world for us and our investors if these unfortunate circumstances do happen. And it is mining. It will happen. And we can, again, look at the list of all the other royalty companies, and pretty much every one of them has this happen to them. So these are the types of risks that we try to mitigate, but they're out there. They're the known knowns, the unknown unknowns, but we try to mitigate them through diversification.
Sure. Okay. So what's the immediate sort of near-term ambition of the company? Acquire more royalties from where? Who are you looking at?
So we are working on a royalty right now. The vendor provided a press release to that effect when we signed the letter of intent in March. So it's a project in Peru. We would be getting 6 and then 15% of the silver that's produced from the asset. They're using the money in part with the debt that they were able to secure to put a mill on site and increase production, lower costs. So it is these types of projects that we're focusing on, as well as we've started to move up market a little bit in terms of size. This one here would generate 55,000 ounces a year for us. So certainly an improvement over where we started, which was 4,000 ounces. Second transaction we did was 16. The third one we did ultimately should be 7. So these are very small compared to what PPX is, what the Peruvian project is.
Sure.
We're also looking at producing assets in larger companies now. We're starting conversations there. Nothing definite, nothing concrete. Something like a PPX. There's another one that we're working on right now. We're quite close to getting a letter of intent out to them. Again, we don't know if that'll close, but similar size to our smaller deals, certainly accretive to our shareholders, because once we do the Peruvian deal, again, we'll be in a free cash flow neutral position, meaning that every dollar that we spend after that on a producing asset will return dollars back to the company, to our shareholders, right to the bottom line. Ultimately, we'll be looking as well at assets as opposed to projects. What I mean by that is a project is a mine that has ounces in the ground. An asset is infrastructure that processes materials that come out of the ground. So it could be a mill, or it could be a recycling facility, or it could be some kind of reprocess center. We're also looking at these types of facilities. Generally, that makes us a little bit different, a little bit unique in the space, simply because there's no reserves or resources on process facilities. So most of the royalty companies, in fact, we haven't seen a royalty company yet attack or approach those types of facilities.
All right, Peter, that's a great introduction to the company. We're going to catch up with you again soon in the future. Thanks for joining me today.
Thank you very much, James.